G'day and welcome to the Small Caps. It is January the 23rd. I'm your host, David Scott. Thanks for your company today. Let's get to our first guest. Philip Pepe from Shaw & Partners is standing by in our Barangaroo studios to discuss what potential we might be looking at with a retailer revolution. Philip, welcome to the program. To begin with, I wanted to go and ask you about Myer, because we've got David Jones in new hands now. We've got a billionaire emerging on the share registry of City Chic Collective. And Myer's share price, over the last 6 months or so, is up 180%. Putting that together, is Myer a potential takeover target that no one's talking about?
Not sure that I'd say no one's talking about it. Remember, they've got Premier Investments on the register with more than just a blocking stake, and I think Premier's been pretty open about what they want to do with Myer in terms of getting a seat on the board and helping it restructure. But look, the Myer rebound's been a long time coming. They were on struggle street a couple of years ago with too many leases, with consumers moving online for their shopping in droves, with people avoiding the CBDs because of COVID. To some extent, that was always going to mean revert as we move out of the homes back into the shopping malls. The Myer MD's done a great job in turning that company around, in part with Premier sort of agitating in the background. But it's something we've talked about in the show in the past. I don't think the retail consumer is dead. They're just switching their shopping patterns. Christmas showed that sales were very strong, but we did switch from online to a lot more bricks and mortar, and Myer will probably see in their upcoming result and the preliminary data actually doing quite well. So I think part of the share price rally is a recovery in department stores, a recovery in Myer, and perhaps the potential for takeover. But you would have thought, Solly's had more than one opportunity to have a look in the past if that's what he was going to do. But you'd certainly expect the company to put out a decent result at its next half-yearly update.
Philip, I'm getting at your views on Myer and its online offering out there compared to some rivals. A lot of people kind of discount it, but having a look online myself, I was quite surprised at the level of range they had there and how easy it was to go and function. Is that something that maybe the market hasn't fully come to grips with yet?
Look, I think so. I think historically, many retailers who were reliant on bricks and mortar didn't invest a lot in online because they didn't have to. They had the foot traffic. With COVID and with declining foot traffic or loss of market share, a lot of the bricks and mortar retailers were forced to improve their online offering and offer same-day delivery, in-store pickup, which has proven quite popular. People want the ability to grab a good price when they see it, but pick it up on the way home from work or when they've got some spare time. So Myer has invested in their online sales, and like many, not latecomers, but not early adopters of the online segment, Myer's seen some strong growth. So for me, the retailers that'll do better going forward are those that offer both online and both bricks and mortar. If you're pure play online, you would have had a great couple of years, but as the market moves back to bricks and mortar, you don't really have an ability to offset some of the declining sales. And we've seen some pure play retailers like Kogan and Adore Beauty, for example, that really suffer trying to grow off very strong comparables, whereas Myer has the dual-pronged attack where they have bricks and mortar for those who want bricks and mortar, they have online and any combination of both. So is it underappreciated? Probably. I think people have been historically focused on Myer's large lease liability historically, but that'll sort itself up over time as they get to the right mix of bricks and mortar stores and online stores.
Another couple of groups that have dual prong when it comes to both like a physical presence and online, Super Group and also JB Hi-Fi. They released quarterly updates coming through last week. What was your overall sense about how those two big blue chip giants performed over the course of the last few months?
Good companies that are well run produce good results. I think they had both record or near record sales across most of their brands, not all, but most of their brands, and in a lot of cases, gross margin going up. We've seen the difference between a good retailer and a bad retailer in the last 12 months. If you've had the right inventory, right amount of inventory, the right type of inventory at the right time, you've had good sales and a good margins, and both JB Hi-Fi and Super Retail Group delivered pretty strong results. I mean, the JB Hi-Fi Australia brand keeps going from strength to strength. We saw comp store sales in the second quarter up nearly 5% in Australia for the JB Hi-Fi brand, almost 10% in New Zealand, and even the Good Guys had 3.3% comp store sales growth for the second quarter of their financial year. So doing very well across the board with gross margins either holding or growing. So that's a good retailer, probably winning market share, but really understanding their client base. And similar, Supercheap Auto had first half sales growth in the Supercheap Auto brand of 18%. 13% Rebel, 55% Macpac, and BCF, which struggled a bit, up 7% absolute, but down 2% on the like-for-like. So most of the super retail group brands doing very well. Again, very well-run business who doesn't just sit there in changing conditions, pulls the levers that they can and gets the higher sales and gets the higher gross margins. Not really reflected in the share prices, although some of them are at 12-month highs, because a lot of analysts out there are worried about this potential weakening in consumer spend as interest rate rises start to bite and we move from full employment into more regular unemployment levels. My experience, the good retailers will continue to do what they do. If you think back to March 3 years ago when the world was coming to an end, the good retailers performed very well throughout that period by pulling the levers that they can pull. So both very strong brands delivering strong results. The market's cautious, but they've been delivering almost year in, year out. So I quite like both these companies at a price.
You mentioned inventory management and how difficult it's been over the past couple of years trying to go and get the right amount of inventory on hand for the conditions at hand. City Chic, it's been absolutely poleaxed on the share price performance, but there's a lot of moving parts going on under the surface now. When you look at that and the update that came through last week, what's the overall sense as to its future moving forward?
Yeah, it's an interesting one. So the risk to City Chic at their full year result was the extra inventory they were carrying and their ability to clear that inventory without having to discount. And they, of course, versus the companies we've mentioned, have a much greater exposure to the US. That economy is travelling at a different rate to where we are. They've had issues with getting rid of their excess inventory. They've had to discount, and they've struggled a lot in the USA. So their Americas sales went backwards by 14%. So you've got Australia growing and the other companies we mentioned today, but they went backwards in Americas by 14%, backwards in Europe by 4%, and even went backwards in ANZ. So because of the nature of the stocks that they sell, their clothes don't go out of fashion as much as a fast fashion retailer, but they tend to last longer. So their customers need to replace them less. So if you've got excess inventory and you want to clear them out, you've got a discount, and the US market seems a lot tougher than the Aussie market is at the moment. So they got caught up in a bit of that, so they took a hit in the US, and after some couple of disappointing trading updates, they were pretty harshly dealt with. I think some of the longer term investors bailed out. And then last week, potential new term investor, sort of a household name in the retail industry, bought a stake on market, and that seems to have excited people, and share prices rallied. For me, a change in share ownership less than 10%, it's hard to believe much can be done with that level, because at the end of the day, good management, tough industry. The tough industry tends to win. So we still need to see how the company closes out the year with its industry levels and what happens in the US regarding its strategy and the level of price-based competition. So perhaps a little early to jump in just because someone sold 8% and someone else bought 8%. I would keen to hear the next trading update to see if the worst is behind them, or if we've got another perhaps quarter or two of tough conditions in the US for that stock.
Okay, so still a bit cautious when it comes to City Chic's outlook moving forward. Just to go and finish off, Philip, Retail Food Group, we haven't talked about it a lot. It was discussed plenty in prior years, but a lot of the wrong reasons. Yep. Now as a re-emerged group, how is it stacking up as an investment opportunity? What is it telling us about what it's seeing when it comes to demand from consumers?
Look, it's had the share price had a really good 3-week period. So they had a positive, or 4-week period. They had a really positive AGM update in late November. And then in December, late December, while most people were on holidays, they finally got the ACCC issue behind them regarding an issue they had with their franchisees, where no fault was admitted. They'll pay a fee. That's now behind them, and they can get back to growth. So their distractions have gone, and they can get back to growing the Gloria Jeans brand and the other brands, both in Australia and offshore. And this has come at a time where, if you look at the retail sales data, Takeaway food, cafes were really strong over Christmas. So as we get back to normal, as we got back to the shopping centres over the Christmas New Year period, you know, the demand for coffee shops and takeaway coffee and donuts and stuff would have all gone up strongly. The industry data that was released over Christmas showed cafe takeaway food was up nearly 20% over the 2 months, November, December, so taking on the sort of the Black Friday, Cyber Monday trading and the Christmas Boxing Day period. Their category was up circa 19-20%. So the ACCC's behind them, foot traffic's coming back. They're probably going to have a strong first half result given industry conditions. Stocks had a pretty significant re-rate since then as we get back to fundamentals and stop guessing what the ACCC may or may not do regarding the stock. Now that we know the answer, it's sort of back to growth for the company, and that's been reflected in the share price. So we quite like this one at Shaw and Partners for the fundamentals and for the fact that the distractions over the last 18 months are now largely behind them.
Philip, we'll have to go and leave it there, but thanks so much for joining us today on the Small Caps. You take care. We'll catch you soon.
Thank you.
Philip Pepe there from Shaw and Partners. We're going to take a very short break. Back with our C-suite interview for the show. Back in a moment.
Tasting the grapes on the Chinaman terrace.
Yes.
Has that since triggered my memory of a childhood that my grandmother's cooking.
But just when it was going so well, the place she'd built to showcase their vintages went up in flames.
Let's get our C-suite interview for the show, and fresh from signing a farming agreement with Gateway. Welcome back to the program, Richard Taylor, SensOre Chief Executive, who's standing by via Skype. Richard, good to go and see you there. For those who are not aware of SensOre to begin with, just give us a bit of a rundown about the business that you're in.
Thanks, David. Yeah, Sensor's in one of those sort of exciting positions of supporting the mining industry with technology development, artificial intelligence. We utilise some of the advances in adjacent industries to be able to improve the way we predict exploration tenements, how we be able to look at collating geophysics, geochemistry, geology, with a goal really to helping mining companies as well as ourselves make more discoveries for those things that we really need for the future of the economy. Battery critical minerals. We're focused on lithium, which today's announcement with Gateway centered around, but also copper and nickel, things that we know the world economy is very short of. We have, I guess, a growing base of people in Perth and Melbourne, people with deep expertise in this area, leaders in geophysics, geochemistry and geology, putting together the best brains to solve some of these diabolical challenges we have to meet the energy transition needs.
So you've got a technology edge over traditional exploration and mining services. Now give us a sense about Gateway and this Montague Gold project. How did that come across your radar as being something that you want to go and work with?
Well, one of the things that Sensor's been doing since its start has been to unpack and learn from the massive geoscience data set in Western Australia. So about 70% of exploration for minerals occurs in WA. They have some of the best data sets in the world. I mean, visionary 20, 30 years ago to make companies put their public data, commit it to the state government and make it available to be able to assist with other companies to be able to explore. This is the best data set in the world for AI and ML applications. We pulled together all of that data, so thousands of layers of information associated with all those tenements, and we trained the computer to be able to understand what a lithium target looks like, what a lithium economic deposit and mine would be. We got it to learn from the traits associated with those targets. So we didn't put in a variable ourselves. We said, what is the fingerprint of a lithium mine? from all the different ways you can analyze the mines we have in Australia and globally. And then we asked for it to search through that database for areas that looked very similar to what an economic lithium discovery would be. We identified Gateway's area early on as having a lot of excitement associated with it. Many people might be aware that gold and lithium are associated in many of the tenements. They're not in the same location, but there is a approximate distal relationship between gold and lithium in WA, particularly in the Lilgan. So we reached out to Gateway. They were excited to bring on our technology. We showed them what our system could do and what it was predicting in that area, and they jumped on board with giving us the opportunity to test our technology in that area. It's also worth mentioning that we're doing this in conjunction with Deutsche Rohstoff, which is a German oil, gas, lithium and battery minerals company out of Germany. As we all know, Europe is looking for not only current energy needs, things that can meet those sort of aspects, but they're also looking to the future, investing in opportunities to corner battery critical minerals relevant areas. And so Deutsche Rohstoff's been putting money into both SensOre and into the projects to be able to expand that supply of lithium and critical minerals for the future of Europe and Australia.
Which begs the question now, about $4.5 million up to being spent on this particular proposal, 4.5 year term that you're going to be looking for. In practicality sense, when do you expect you're going to see some of those results that might come up after you've done the analysis through AI already?
Yeah, definitely. We're keen to get on the ground straight away, and I know Deutsche Rohstoff and ourselves and Gateway are keen to see deployment on the ground as quickly as possible. We have a number of lithium targets that we're putting together in this portfolio, another one with Lith Gold as well. We're out, I guess the first phase will be on the ground, getting our geologists out there sampling the pegmatites where they outcrop, the predominant host mineralization for lithium discoveries. We should be able to get a pretty quick reading there with our multi-element geochem about the lithium potential. I'm planning to really hit that area with a drill program later in the year. We move quickly. We've been through a number of targets in the last 12 months since we listed. We get in, we test, we validate the system. We've made gold discoveries on our locations where we've tested before, but we're really looking for big deposits, and so our chance to be able to zero in on an area, get in, drill it, test it. If it's successful, push it forward to advanced exploration. If it's unsuccessful, we have to walk away quickly. But we're in the game of making discoveries and not hanging on to projects. So I think you'll see things very quickly from us. And then as we evaluate this Gateway project in Montague, it's got great facilities, great infrastructure in that location. It used to host a existing producing gold mine. So we don't see any obstacles to being on the ground quickly and efficiently in that program.
Exciting technology you're working with. Looking forward to following the story and see how you go there with that partnership with Gateway. Thanks for joining us on the program, Richard. We'll catch you soon.
Absolute pleasure, and look forward to catching you next time.
Richard Taylor there, SensOre Chief Executive Officer. Well, that does it for today's episode, but make sure you stick around. Cracking Crypto is coming up after this very short break.